And we're back, just like that. Episode 159 of the Energy Week show, Energy Week podcast. It's good to be back. We've been off, 2 weeks, Dr. Wald?
Well, yeah, I mean it has been. We did the short episode and then we were off and now we're back. So
Yeah,
hope
yeah.
everyone's having a fantastic summer.
Oh, no, we did do one, the short episode. That's right. That's right. I forgot about that. So it feels like it's been 2 weeks, but it hasn't been. Okay. Yeah, down on vacation last week, and so we are back in it for the long haul now. Dr. Dean Foreman will be joining us for his monthly visit here in about 30 minutes. Hope everyone out there had a great Father's Day holiday weekend. And I tell you what, it was nice to go catch some fish last week on the beach. So I don't know what's been happening in the world, but I come back and it feels like a lot. So it feels like it's crazy. Let's start here. Global passenger aviation's uneven recovery from the pandemic. This is from our good friends at Reuters, who say global passenger aviation is making an uneven recovery from the pandemic. Yeah, I think that's put it mildly, an uneven recovery compared to an even recovery, which is what they're hoping for, I suppose.
Yeah, I think it's interesting because we saw that the TSA, I think, recorded that they screened 2.1 million passengers
Mm,
yesterday
mm,
on like random Sunday in June, Father's Day. Maybe not such a random Sunday, but so they screened that many passengers in June, and yet there's a huge difference between what we're seeing in the US in terms of air travel and what we're seeing, say, in Europe in terms of
mm.
air travel. Um, well, part of me wonders if I wonder what train travel in Europe is like, because yes, there's a lot of air travel, but like train travel is much bigger in Europe. So I'm wondering if
Right.
more people are taking to the rails, or if this is, or if there are just fewer. Really, like Europe is still closed, people aren't moving. It's down there, and then I think international travel is definitely down. Although I think there are signs that it is coming back. I know I flew um, like recently, and I was flying to the UAE, and I know that Emirates is looking at, or I think they're definitely restarting their international flights to a lot of areas that they had previously shut down. So I think it's definitely a positive sign, but there's still a lot of international air travel. It's not happening and just not available. And that's still an issue for jet fuel.
Well, yeah, as we said before, you got to have those big, long, fuel-consuming flights to kind of get things back to normal. And I don't know. I didn't see the full. I saw a headline, but is Britain, are they back in lockdown again, or do you know what's going on there? Because I thought I saw something about they're shutting down again. Did I misread that? Do you know?
It's like impossible to know. I think they were supposed to end the lockdown, but now they're extending it like to some point in July. It's very complicated, but a lot of people are having a lot of issues from this because, and like Britain keeps changing the countries that you're allowed to go to Britain from. They're like, this country is now in yellow, this country was green and now it's yellow, this country is red and now it's
Mm,
yellow and then it's
mm.
green, and I think it's driving people like absolutely bananas
Right.
because
So,
apparently
well,
people from like red countries can go to a green country
mm,
and hang out there for like 2 weeks
mm.
and then go to Britain without having to like do their extensive quarantine. And so people are like, okay, like I'll vacay in Spain or Portugal
Mm.
or Iceland or whatever it is, except that they keep changing which countries you can do your fake vacay quarantine in.
So, yeah, when you think about vacation travel, unless you are just dying to go somewhere, like you have to go see Mount Everest for some reason. If you're like, well, if there's a lockdown in England and I gotta fly through, it's just not worth it, right? If you're on business travel and you have to get somewhere, you're gonna figure out what the rules are, vaccination, all that. Like you're more willing to put in the time. But vacation travel or leisure travel, you're just gonna say, forget it, I'll go somewhere else. And so with all these rules up in the air, and it's not really clear what you can do, how long you gotta stay in country. Do you have vaccinate when you get back? So we were looking at going to Cancun for a sort of vacation. and they said that they got to do the test, and if you fail the test, you got to stay in country 14 days, right? Now, I suspect that they're not actually failing anybody. Like that's my, I mean, because think about it. If you're there, where are they going to put you at for 14 days? Do I got to pay for it? Do I go back to the hotel? Do I go to another hotel? Like you're like, well, never mind. We're just not going to go because the risk of going down there and popping a test for COVID and then being stuck in Mexico for 14 days, we're not sure how that would work. And then what if you fail, but the rest of your family doesn't? So I think until those kind of things are ironed out, you're just going to see people for leisure and vacation just say, whatever. And even for business, because there's a lot of conferences that we used to go to. And it's like, you didn't really have to go to those conferences. And so as those come back, you're going to start asking those questions. So until the COVID protocols are clear, I don't think you're going to see it come back.
Oh yeah, it's totally. I mean, like I was freaking out. I don't think I ever felt so nervous about opening an email about like a test results, like since, I don't know, I like took the SATs or something. I felt like literally like I was like, oh my God, am I going to be stuck here for another 10 days? Or do I get to go home in like 3 days? Like I'm planning to. And it was like, I felt like I was opening like my college acceptance letters or something ridiculous like that,
Right.
Whereas in reality, like it's a nasal swab, but like this is a big deal. So yeah, these things like they gotta go. Like travel's just not gonna pick up until they go away. Like you'll have like intrepid people who are like, yeah, I'm doing it, and then you'll have like, if it's like you're stuck at like grandma's house. Okay, so what's another like 10 days at grandma's house? But it's not the case in a lot of these places.
I've always wondered about these consumer confidence indicators, but this is one time where I think it's pretty useful, like consumer confidence in being able to get back or whatever. Because if you're concerned about not being able to get back, then you're just not going to do it. And and especially if you get stuck mid travel, like you go to the UAE and you fly back to France, but then you're stuck in France. So there's a lot of problems. Okay, up next we have from foreign policy, the good Dr. Wald and Jonathan Ferzinger, I think is it?
Yeah,
Yeah.
Ferzinger.
Climate policies could hand power and profits back to OPEC. Now, why would that be, Dr. Wald? How could climate, how could that hand policy power back to OPEC?
This is a fun piece to write. It was basically kind of inspired by Prince Abdulaziz's comments about the IEA scenario being La La Land. And if you look at it, the way that that things have been going, particularly since then, and also with that, you see so many, you've got this stuff happening with Exxon, you've got the court ruling against Shell, and you've got like even BlackRock saying, we're not going to include you, and we're not going to in the biggest funds if you don't, adhere to whatever, climate commitments we've decided we want you to adhere to. And it exposes the fact that there are a large number of oil producers that are completely and utterly immune to these issues. I mean, like NOC, like Russia, you think Russia cares about what BlackRock says? Do you think like Saudi Arabia cares? And it's interesting though, because a lot of they play the game very well. It's not that they don't acknowledge the issues with carbon emissions. It's not that they don't, talk about the energy transition. It's not that they're not interested in other types of energy. I mean, like I mentioned in this piece, and I mentioned it in my book, in like 2006, I think it was, Ali al-Naimi said, when he was oil minister of Saudi Arabia, he said on 60 Minutes, he said, we're in the energy business. Like we want to do solar power. We want to export barrels of oil and gigawatts of energy. Now, that was like 13 years ago, I think, or something like that. Is Saudi Arabia exporting gigawatts of energy? No, not even close. I think they just finished their first like 300 megawatt plant, or if was it even that. So no, they're not, they're not doing that yet. And so the question is, I think, they're not making the same. They're making they talk about these commitments, but they're not investing in them in the same kind of risk that BP and Shell or Exxon are taking. Like these companies are literally reorganizing their entire businesses, and it's a risky proposition because like investing in wind power is not necessarily going to make it the same kind of money that oil will. Maybe not. And so, but look, I mean, we're going to talk about, is oil going to go up to $100 a barrel in 2022? If so, Saudi Arabia is poised to just rake in the money. They're going to produce it at like $2. So
this, I think this point is, it's not just oil. I remember reading, I think it was John Bolton's book on Trump, and he was talking about, what's it, the IMF, not the IMF, the Interballistic Missile Treaty that we have with Russia. I can't remember what it's called. But anyways, he was complaining that, the U.S. has all these lawyers that all they're doing is trying to make sure we're always in compliance with these interballistic missile treaties. But then Russia just goes and does whatever it does. But both sides have signed the treaty. Only one side is trying to hold to it, at least according to Bolton. That's the same thing with these Paris Accords or these net zero standards or whatever. It's great if everyone agrees to them, but the ones who apply the practices and then try to hold themselves accountable, they're more likely to suffer than the rest of them because they're not going to do anything. And so when you look at Chevron and Shell and these big majors, they're getting pressure from the U.S. stock investors, and we've kind of talked about the Saudis going public and what that may or may not do to them. Well, it's not going to hurt them with their stock investors. Like, their board is not going to really pressure them to change their business model, and there's not going to be in court rulings won't. There's not going to be a court ruling that's going to change them. So I think you're onto something there that if we're not careful, you shift the balance of power to them by judicial rulings or crazy board of directors, and then what do you say when you're in 2022, 2023, 2024 that if the balance of power does go back, what do? Because you can't get mad at them because you shifted the market to push it back towards them, right?
Exactly.
Because the shale producers are causing them problems, at least with trying to keep the prices stable. But now you've kind of you start to eliminate those guys. Well, then you're back to where we were.
Exactly, and it's I mean, I think we could see in a relatively short amount of time. I mean, we were already seeing, if OPEC is holding back a lot of spare production from the market right now,
right,
and they've got some really good discipline going on right now, and there's you cannot say that OPEC is not influencing the market right now, because if Saudi Arabia was producing at 10 or 11 million barrels of oil, the prices would be lower. And the same, if everyone was producing to the capacity that they want to if they could, we'd have a lot. I mean, there'd be a lot more barrels on the market, and so you can't say that there isn't a modicum of power that's shifted back to the the OPEC powers. But what's interesting, of course, is that the oil's still there. Okay, like the oil's still in the U.S. Like it hasn't gone anywhere. It's not like the fields are like tapping out, right? So it could be produced. It's just not being produced. So does that mean that at any point, like either there's a shift in mindset, there's a shift in someone comes in with lots of capital and starts handing it out like candy to that we could turn that around when we want, because the oil's still there. So it's, I mean, in, a couple of years, the political atmosphere could shift. I don't know. It makes me wonder, like, can we consider all that oil that could potentially be being produced spare capacity the way we talk about like Saudi Arabia has spare capacity? I don't know. It's interesting because like you could say like, oh yeah, the shale. I mean, it's the fact that the shale producers aren't producing. Could we say they're in cahoots with? I mean, they're effectively cahooting with OPEC. Is cahooting a word?
Yeah. Well, so go back to something you said a minute ago. Mr. Wonderful, Kevin O'Leary from Shark Tank. I've seen him twice on interviews recently, and maybe 3 times. Anyways, And he always brings up the fact that he gets pressure from his investment groups to get like Schlumberger and these companies out of his portfolio. So he took them all out. And so I wonder now. He didn't say the time frame or whatever, but I wonder how much of that was tied to the fact that those companies weren't probably making a lot of money last year. So how much that went to it. So if oil, we got another article that says oil is going to go up to what 15%.
Yeah.
So if oil continues to creep up, will that narrative change? Will these investors keep saying no, 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 no? Or the other thing to watch, I think Anas pointed this out on Twitter, is that if OPEC, if you look at OPEC, they cheat on their quotas. Okay, well, these companies will be cheating on their carbon emissions. So we get to the point to where you'll have Exxon, who's saying that they're doing, carbon capture, or carbon neutral, or whatever, but that's really a smokescreen, and yet they're producing the same amount of oil or more oil. So could you get it where it sounds like they're carbon whatever, but they're really just doing that so they can get the investment money back in, and so you kind of build it up that way. It just would cost more to produce the oil, though.
That's a really good point. And then another aspect is also, what if these companies decide to go private?
Right.
Then what do they care what do they care what BlackRock says, or what investors say? I mean, what if they didn't what was it? Dell. Remember, didn't Dell, they make computers, and they just they're like, hey, we're going private. There's like a giant like real estate company in the UAE that's like going back to private. So hey, Schlumberger, go private. Then you don't have to care about like what. I'm just saying that like that's an option. And there was someone posted something on Twitter. I think it was Tracy who posted this on Twitter last night. It said that the difference between publicly traded, the public shale companies and private shale companies is the private shale companies are drilling more and the public ones aren't. So, I think that's an interesting thing to watch. And I wonder if the public pressure trend will actually just lead to people like, hey, there's money to be made here. Let's go private so we can make the money instead and not deal with all of this, crap.
What is the one company that we've applauded? The one old company who's like, yeah, we're an old company. They're over there. It's is it the UAE? Maybe I can't remember who it is. They're like
ADNOC.
ADNOC, yeah.
I thought it was Norway. Wasn't Equinor was like they came out there or like Norway was like, we're going to continue investing in new oil and gas resources because there's money here, but we're going to like build windmills too so that domestically we can power Norway on clean energy, which makes sense for Norway, which gets most of its power, I think, from like hydro and geothermal.
Okay. One more. I think we have time for one more article before Dr. Foreman hops on. From the Wall Street Journal, the natural gas glut has evaporated, driving prices higher. And the thing I thought about when I saw this headline was it's the glut's quote unquote gone, they're saying, but also how much of that is being tied to the lack of U.S. oil production, right? Because oil was producing so much natural gas, especially in the Permian, that they're flaring it off out here. So if you see these higher oil prices and you do see drilling pick back up, will you see the glut, right back in play?
That's exactly what I was wondering, is how much of this is because we're not drilling oil. I'm curious to what it is that they say. I mean, because if you're saying the glut is gone because the prices are up, that might not necessarily be true, because speculation is going to be super hot summer, it's going to be this and that, or we're like exporting a lot or something. So, but is it like actually like less production? I'm looking at this article. I'm not sure it really explains. Okay, it says Appalachian energy producers, which control the country's gas spigots, have taken a cautious approach to reopening the wells they shut last spring. Drillers in the Haynesville Shale that straddles Texas and Louisiana have been slow to tap the reserve wells, which have been drilled but not yet fracked to start them flowing. Oh, it's all in the ducks. It's all in the ducks. Sorry.
Well, no, but you got to be careful, because if oil prices do stay high and U.S. production does start to skyrocket, and you're a natural gas producer only, then you'll get buried because you're out here and the price will start to collapse. And so you're kind of in the spot to where you do have to be somewhat careful. Otherwise, you're you'll get caught in a what's the
There's
saying,
also
rock and a hard place.
there's also the issue of apparently there's drought and that's reduced hydropower in the US. And so they're using more gas to cool, for electricity
Hmm.
there. And, this is again the issue of making everything electrified.
Hmm.
So they're like, no, New England, you can't use natural gas to heat your homes and your stoves, and same with San Francisco, everything must be electric. Well, now they're just using the gasoline. I mean, they're just using the natural gas to produce electricity that they're using to. So it's like, but every time people talk about this hydropower issue, all I can do is think about Venezuela in like 2015 when they were like, Venezuela has so much oil, but they can't keep the lights on because they have a drought because most of their electricity comes from hydropower because they want to sell
Hmm.
all their oil. It's like, okay, like this is an issue. This is a well-known issue that happens. So,
Yeah,
like, what are we
you
going to
have
do about it?
yeah you got to have the water to get the hydro to work. I'm trying to think of where I heard it. I was on vacation and I heard someone go on a rant about nuclear. Like the whole thing is stupid if we're not talking about nuclear. God, I'm trying to think of where it was. Maybe it was on DRW's podcast, but there was, yeah, I think it was. If you go listen to his most recent Hot Take of the Day podcast with, I can't remember who it is, but anyways, Patrick Moore, something like that. Um, there was a big thing about nuclear. And just his point was just driving home that, if we don't put out more nuclear, we're going to always have continual problems with baseload.
Mm-hmm.
And I mean,
Oh yeah.
that's hard to argue those kind of facts. So
And I feel like a lot of people know that and acknowledge it, but like no one's willing to actually do the hard work to deal with it. Like I do feel like a lot of people are like when it push comes to shove, like they acknowledge, yeah, we're gonna need like nuclear is what makes they're like they say like either nuclear or natural gas is what makes renewables be able to have a part of the market, but not enough people will like it doesn't play well. I don't know what it is. It's like
well,
why what's the hurdle?
you spent what, half a century at least putting the fear of God of people about nuclear, and so I mean just look at COVID. Wherever you think on COVID, there's plenty of people who are still extremely scared, and there's people who are still extremely irreverent to it. And people's minds just don't change overnight because you change the narrative.
Yeah.
Whatever side you come to the nuclear debate, if you're like us, which is pro-nuclear, it would take a lot to change your mind, and on the other side, it's going to take a lot to change their mind. So I think that you have that. The other thing is, how do you start justifying rolling back the regulatory stuff in the U.S.? Because if people were scared of it, and so you say, well, we got to get the cost down. So one of the ways is to modify some regulation. You start doing that, people are going to lose their mind because they're going to be scared to death. And I don't know which regulatory stuff with nuclear you should or shouldn't re-examine, but just I think that's part of the thing. Either you have to re-examine the regulatory practices, or you would have to subsidize it, right, to make it more cost effective.
Yeah.
But it lasts for like
Yeah.
60
Yeah.
years.
Or I know. And it takes so long to build them too. And we're in the process of like we're still going the wrong way.
Yeah, we haven't turned the car around yet.
Yeah. Exactly.
Well, I don't, I do wonder with the nuclear stuff, and I think I said this on the Global English podcast years ago that will you get to a point to where you will have a mass power outage, kind of like we saw here in Texas, but a few months ago, but it really has a significant death toll, like not to diminish what happened here, but like a severe, like New York City, Chicago,
Yeah.
Paris, London, like it's out in the thick of it, in the heat, especially because at least in the winter you can
Mm-hmm.
fire up you can build a fire, and you have a significant death toll, and then nuclear kind of is brought back into the picture. I hope it didn't come to that, but I've wondered if it will take something like that to kind of get the public sentiment back to where it needs to be.
Yeah. I wouldn't be surprised. But I mean, you're fighting against like, Fukushima,
Right.
which a lot of people still remember. I mean, the
Yeah.
policies now are basically like Germany getting rid of all its nuclear plants is a direct result of Fukushima.
Well, okay, so you take that, and then when I was fishing last week, I know I got up one morning and it said that China had some nuclear plant that was leaking potentially, but that didn't seem to make a big headline. So did they clog it up or stop it or denuclearize it? I don't know. I just
China's the big black hole. No one knows it. Yeah.
You remember when Don Lemon or Don Lemon asked if a black hole could have sucked in that plane over the Indian Ocean?
Yes, that was after CNN. That was, by the way, that was after Anderson Cooper had a psychic on to try to figure out where the plane was. How come we can't bring back that CNN?
Thank you.
Please. I liked watching that CNN. That CNN was great television. I want to know about where is that plane? Could they please do a follow-up? Actually, I read an article, a follow-up, I actually read a really interesting article about after all this time, what they actually think happened to the plane.
The pilot did it, didn't he?
Yeah, and he just flew the plane, he depressurized it, everyone died, and he just flew it until it ran out of stuff, and then it went down somewhere, and they started finding pieces of it in random places. It was an interesting article. Sorry, this is a total digression.
Well, we're waiting on Dr. Foreman, so this is a filler time here on the Intrigue podcast.
Yeah.
I was telling my son about this the other day. Can I explain to him last week? Actually, I think it was. But the thing that I still never figured out is how do you have these multi-million-dollar engines, these multi-million-dollar planes, and the pilot can literally turn off the transponder? He doesn't own the plane. How is that the case? I don't understand how you could have such a thing. It figures you would want to protect from that. Speak of the devil himself, Dr. Dean Foreman.
Save us from speculating about where the plane from Indonesia.
Yeah, that's where we were killing all the time there trying to figure out how to do that. Let's see here if I can get you on the big screen. There we go.
Hey.
How you doing, sir?
Doing great. How are y'all?
Doing good. So we are a week behind schedule. We were at.
I like your attic setup.
Oh, thank you. It's been the perfect COVID hideout, I guess, for getting work done.
Okay, well let's get into this report, which came out last week. So let's get into it. According to the executive summary, we'll start there. The primary data for May 2021 reinforced how the recoveries in U.S. economic growth and petroleum demand have continued to go hand in hand. Now, we were talking a little bit about some economic stuff, but give us your read of the economy as it pertains to oil demand and gas demand.
Well, this just kind of reinforces what we've been saying for the last couple of quarters. 2 quarters ago, we were saying, wait for it, the economy's coming back, and likely oil and energy markets along with it. And now, both in the U.S. level and the global level, by API's primary data and on the global level with the U.S. Energy Information Administration's primary data, we're seeing demand in April and May, not just back very close to, it's well above year-ago levels since the base year was affected by the pandemic, but really within a hair of where it was in 2019. And those months in 2019 were the highest for petroleum demand in the U.S. in 11 years. So with a really high benchmark, we're really close to that. So this says the $20 trillion of economic stimulus globally is doing something. It may not be very targeted in the sense that it's filling in the most affected and helping the most affected countries, communities, households. But in a broad sense, it's definitely stimulating things, and it's causing some price inflation. You're seeing that across multiple supply chains. And it's showing up in the demand and petroleum data. And as more people are vaccinated in the US and going back to work, it's clear that the urban commuting is picking up. We see this in spades. It's really clear. Now, the trend that contrasts with that and is a bit concerning is when we look at capital expenditures and investment and drilling activity along with that. The investment numbers from the first quarter, where we have complete financial reporting across some 200 companies for the entire value chain, it's never been lower, never. even the weakest quarters of 2008 and 9 during the great financial crisis. So even as revenues and net income and cash flows have gone positive and improved, the CapEx went down. And as I talk to member companies, and keep in mind the plural of anecdote is not data, but in talking with some of these companies, they'll say they're people limited. They've cast off so many employees over the last year or two that if they want to expand their activity level beyond their current budget, they have to rebuild the capacity to do these projects. They have to find where the employees went. And that doesn't happen instantly. So here we are with, as we look across the indicators of productivity at the well level, at what price it takes to at least break even in drilling new oil or gas wells in different basins, at these recent prices, it sure looks like drilling should be profitable, but the activity hasn't been picking up in tandem with it. So is it just a US issue? That's the next question. And the other thing we look to is, especially the Middle East and North Africa, the MENA region is the other place you can go for oil relatively quickly and at a low lifting cost. And we cite API Corp, the Arab Petroleum Investments Corporation, their data, and they do a 4-year roll-up of an outlook of committed projects and planned projects, shows rather clearly that the total of investment, as you'd expect over the last year for the outlook period, has gone down due to the crisis. Okay. But in the committed projects, oil is like 42% of the spend. In the planned projects going forward, it's only about a fifth. So think of the economies and the headlines of wanting to diversify their economies off of oil and gas to have multilateral banks that really want to fund things other than oil and gas. And this is showing up on a sovereign level where you're seeing a shift off of oil investment. So we've got a record demand recovery, actually, expected this year and next from EIA of more than 9 million barrels per day. We also have to replace the natural decline in oil wells. To do that's going to take investment, and record low investment's not going to cut it when we get into next year. There's just not enough spare capacity to make that happen.
So, I mean, that covered a lot of the questions that I had, but I was really curious if we could just go back a minute to what you were saying about the oil estimated break-even prices. And there's a really interesting chart. I know maybe we didn't get to this. We were supposed to be looking at the statistical report, but I skipped right to the industry outlook for Q2 because, I'm just itching to get my hands on that. And it's a really interesting slide that shows the change in estimated break-even prices. And it seems like in two areas, the current dollars per barrel, like it has actually risen as opposed to decline, whereas in a lot of the other regions it has. Maybe you could talk a little bit about what is different about those two regions. I'm on slide, I'm not sure.
Probably 13, I believe.
Yeah. Slide 13.
So this is looking at, for oil drilling across the major producing basins in the U.S. for the audience. This is showing a comparison year on year for May from BTU Analytics of what West Texas Intermediate crude oil price you need to at least break even in drilling a new well across these different basins. And across most of the basins, the numbers are, the $40 to $50 per barrel kind of range. And in most of the basins, they've actually gone down year on year. Now, that's not been the case where they've gone up slightly in the Delaware basin the Delaware portion of the Permian Basin, whereas the Midland basins continue to get more competitive. But it's still in the low $40 per barrel range. So it's gone up a little, but it's not losing competitiveness in a substantive way. The Denver-Julesburg Niobrara Basin in Colorado is a different story. Now, this one has gone up, and in the estimates from BTU Analytics, it first went up to like $68 a barrel. Then it was down towards 60, and now their estimate is closer to $50 a barrel. But what's happened there is Colorado, the important overlay for a lot of these is the policy framework that goes with it. And Colorado as a state has been imposing more stringent regulations. There's what's called a setback regulation. So the distance that's required between communities and oil and gas drilling activity. They quadrupled that effective in January from 500 feet to 2,000 feet. And while that 1,500 foot difference might not seem catastrophic when you start actually laying it out on a map and doing a locus around where you have activity and where these community centers are, households, schools, any kind of human activity, suddenly it has pushed all of the drilling activity to the very periphery of the basin. So BTU Analytics tells me that the places that are seeing what little drilling's been going on in the DJ Niobrara Basin has moved to places where there hasn't been drillings in several years. And at the time, the analogs or the comparisons that they have from when those areas were drilled several years ago, they weren't de-risked to the same extent. The break-evens were higher. So that, hence, the initial comparison was closer to $70 a barrel. And it looked like, well, why would you ever drill that given current prices? And sure enough, as they're continuing to drill and tie in some infrastructure, it looks like the break-evens are closer to 50, but it's still been a lot higher than the other basins. And we'll see. But that's a shift in activity. They've saw actually in the Bakken Basin as well, which this month is showing a decrease, but in prior months had also shown a year-on-year increase. That there's been a shift in activity there, but it's not related to regulatory activity. It's just a function of who's drilling and where they're drilling. So this is the small sample size problem, I guess, is that you don't have that much drilling going on compared to what you have historically. So as different companies which possess leases in different acreage are experimenting with different things, we'll see how it turns out. The good news is that the recent prices for WTI are high enough where the economic price signal to drill should be there. And now the question is the financing there, and is the wherewithal and the capacity in the companies to make it happen, is that there?
Yeah, one of the things that I mentioned earlier on the podcast that I saw that someone looked at, I can't remember who, but someone looked at the difference between private companies drilling and public companies drilling in the region, and they saw that the private companies were actually drilling more wells, new wells, than public companies. And so it's an interesting distinction. I wonder if that's something that you're seeing in your conversations with various companies.
I think that has been one of the shifts, just because of the way capital flows and is available, and that there's not as much questioning externally as you're trying to go and just ramp up your activity level. You can make decisions a little faster. Some of the public companies, and we're seeing one aspect of this is more capital discipline and just continuing mergers and acquisitions, and these going into entities that have to decide to do this as part of a larger cycle and have drilling programs approved in that context. That does change the dynamic, and we'll see how it plays out if the U.S. is as nimble as it has been. One of the things, API, we don't create or publish our own forecast on this. For the longer term stuff, we tend to cite external sources like the EIA. And when we cite the EIA's oil market balance, what's really interesting, it's excellent modeling, by the way, but their modeling for the short term out to the end of 2022 forces an equilibrium. And it says between the first quarter of this year and the end of this year that the U.S. its output for crude oil should rise by 1.5 million barrels per day between the first quarter and the fourth quarter. Well, how's that going to happen? I mean, if you look at the drilling activity, which is creeping up by 3 rigs, 6 rigs, it's not like we're going back to 2019 levels, which were so much higher in terms of drilling activity. Even with strong productivity levels, without more investment in infrastructure also, it's really hard to see, looking out the window, how you have enough activity level to have the U.S. be that balancing factor, both for U.S. markets and trade and global oil markets.
So, I mean, I know we've talked about this before, but why aren't they updating their model?
Not a question for me, but
good point. Yeah, good point. Well, that's a question. We'd love to discuss that with someone if anyone's listening out there from EIA and wants to discuss that.
Well, I think it's. If I had to hazard a guess, I think they'd say, well, look, we have an approved methodology. We've gone through this, and it's reasonable to have an economic model that requires that you balance supply and demand. Now, you have, as the intelligent consumer of this, have to look and see, okay, when it says that, as the EIA does currently, that this is going to rebalance, and then after another couple of quarters, the market stops being short in that view, with the U.S. expanding like this. And then you get, in their view, $60 per barrel crude. But yet, looking out the window today, we are $14 to $15 per barrel higher than that on a Brent basis. And by the way, looking out the window today, this afternoon, the Brent WTI basis price differential has been less than $1 per barrel. What's that tell us? Well, that tells us that there's a pull for U.S. crude oil exports, where U.S. crude oil has been relatively cheaper than international crude oil. It's pulling those prices together. And at some point, if the international demand for crude oil is accused, or if exports are blamed for raising domestic crude oil prices, that's where we get blowback on the whole of U.S. crude oil exports. So we need to see how this goes. But right now, consumers, I don't think consumers are planning for a continued rise in prices. And this is one of the things that we have to continue to message on, is that signals matter. What's happening with that moratorium or pause that we've had on federal leasing of oil and gas on federal lands, what we've had in terms of tax proposals to raise the costs on industry, these bubbling up of state regulations that we mentioned, like in Colorado. A lot of these things cumulatively do affect the price expectations that futures markets factor into the price that we're paying today.
Okay, so with all that being said, we talk about the EA projections. They're projecting that by the second half of 2022, liquid fuel consumption could return to 2019 levels. You have a great chart here breaking down where some of the refined products were year to date 2021. Now, from your perspective, you've been following these numbers. Are these kind of back to where you thought they might be at this point, or are we still kind of lagging behind? Because Elle and I were talking earlier about global flight numbers. That still seems like that's going to be kind of off the pace because uncertainty about getting stuck somewhere in some foreign country. So how do you feel about these refined product numbers?
It's funny. I was on a different seminar last week where someone on the global basis was commenting that they just didn't see materials, oil going into petrochemicals and materials, as being a savior through an energy transition. And it may not be in the long run, depending upon what extent of change we see on the transportation side. But to answer your question, I think we're ahead of where I expected we would be, both an aggregate demand perspective, and as we're recovering, we know compared to 2019 that people are still driving less and flying less. There's no question about it. But there is a lot more freight shipping. We're continuing with that shift towards online retailing to see that stick. And then these other oils that we've talked about in the past on this program, where you've got intermediate products like naphtha and gas oil, propane and propylene going into the refining and petrochemical sectors. Normally, historically, back to 2017, that's been about a quarter of U.S. petroleum demand, and it's just burgeoned. It's still sticking. It's at least 27% of U.S. petroleum demand as of May. It had been as much as 1/3 earlier this year, and this is an enduring need as we see continued variants of COVID for medical plastics, for packaging to support that online retailing. It hasn't gone away. So there was a belief by some in industry that this was just a seasonal blip, toward the propane that goes into winter heating and helps keep turkeys alive in Minnesota, that kind of thing. But even as we've gone to warmer weather now, we're continuing to see strong demand in that category.
Okay, I know there's been a big debate on Twitter about how much demand there really is compared to where we're seeing crude oil inventory. So obviously you have some inventory data in your statistical report. What's kind of your read on where we're at as far as crude oil inventories? And obviously you can't make price predictions, but as far as historical pricing goes, do you feel like we're in a good spot as far as how the pricing has worked relatively in the past?
The inventories haven't sent us any bold signals other than directionally they've continued to ease off of those records that we saw, in the middle of last year. So, look, the market, is it short? No, and days of supply in terms of refined products, those have been pretty healthy too, give or take the Colonial Pipeline disruption sort of thing. Basically, refiners are and have continued, even as there's been a lot of variance in our weekly tracking of data on the demand side. Refiners are looking forward, and they've been planning and ramping up their activity. In fact, we, in the latest weekly data, had refining activity the capacity utilization rate was around 93%. So, I mean, that's back to 2019 kinds of levels. And that's what we're seeing, that if the industry is planning for that, the inventories are not likely to take us short. Now, the one thing that is concerning is that instead of close to 13 million barrels per day of domestic crude oil production, we've still been hovering around 11 million barrels per day. So that's 2 million barrels per day relative to 2019 that has to come from somewhere else. It has so far been, to the extent we need more of that, been coming on the margin from imports. And hence, EIA has the U.S. being a net petroleum importer this year and next on an annual basis. As of 2020, we had celebrated for the first time in 58 years being a net petroleum exporter. So we've reversed that, and we need to see week to week what happens. And if the prices internationally continue to go up, who knows? You could see a continued pull for the exports, but the domestic production has to be there to support that.
Well, am I read the charts backwards? Because it looks like we have the third highest May crude exports at the top of the 5-year range, and then the imports it's not the bottom of the 5-year range, but it's down there towards the bottom. It looked like we have substantially more exports than imports, but I guess that's not the case.
Well,
I'm reading the charts wrong, I guess, is what I'm saying. Listen, I am not a chart man. We know we've gone over this, as Ellen said multiple times in this podcast. So,
well, let's pull it up here a second. It's easy enough to look at. So, I mean, the crude oil part of it, if we're looking at the trade, crude oil exports are kind of near the top of the band, but the crude oil production that's supporting it is what's down. Right. So if you take a similar amount year on year of exports, but you've lowered the amount of production, it's greater pressure on the domestic market to support that. Now, in terms of total petroleum imports, those have continued to rise through this year, and they're certainly above where they were last year. Yes, they're down compared to the 5-year range, sort of toward the middle of it. But again, that 5-year range are petroleum imports, not imports, but the absolute imports were quite high if we're going back 5 years.
Yeah, as I think through it, I think we'd have to go back to those charts where we had the line that was outside. Remember those we had for a while that were way outside the 5-year range? It was probably some of that, because as I look at the numbers on the side, I see obviously the million barrels per day is substantially lower on the exports than it is on the imports. But wow, that was a crazy world back then. I knew the chart showed it, but now you're seeing the third highest exports in May, and we're still substantially off the number to get to being a net export again.
It's a great question and a really keen observation, because these numbers really have not. I mean, it's like deja vu, right? I mean, it really is like going back to where you were earlier in time, but at the same time seeing some tectonic shifts from month to month and week to week. If we took the latest EIA and API weekly observation, not the monthly one that you're seeing here, we've flipped from 1 week importing on net 2 million barrels per day to basically being balanced last week, for I guess that would have been data through about the 11th, for the first time in many, many months. So it's not been happening a lot, but there are, and again, the relative prices are going to drive the pulse of exports and create a pull for that. That's the thing we need to watch, and whether domestic production can and will ramp up to support it.
Okay. All right, Dr. Foreman, is there anything else that we didn't touch on that you want to mention before we get you out of here today?
I would think in the quarterly, the things that matter is really taking away this notion that we need more investment and we need policies that enable that. And that's where the rubber hits the road, I think, for all of us, as we watch the current administration in action. And if we don't think there's a cost to policies that are averse to energy, and in particular oil and gas development, we're seeing it. We're seeing it in our pocketbooks now. And prospectively, we're highlighting both in the US and internationally where we've got a dearth of investment. That's a trend. I participate a lot as an advisory board member of the African Energy Chamber, and they're concerned that many of the emerging economies around the world signed on to the Paris Climate Agreement, believing that there was going to be technology transfers and explicit support as we approach an energy transition. And now with the IEA's release of that net zero to 2050 report last month, they're really concerned that they're being told there should be no new oil and gas investments globally at any point going forward. Now, at the same time, one department in IEA has put out this scenario for net zero emissions to 2050. Their oil market report, coming from another department, didn't mince words and was very clear in saying that current supply cannot keep up with current demand, even in the IEA's view. And usually the IEA is quite bearish. So, net, I think we need to really be cognizant that the world needs, and we see this, as we started the program, the economy and oil demand going hand in hand to a great extent that really hasn't diminished as a result of all the dislocation through COVID-19.
Okay, and to all my African friends out there, we feel your pain. Ellen and I have talked about this on this podcast ad nauseum. So we yes, agree. These policies are very much disproportionately impacting the emerging markets. Okay, this report, usually, as I said at the beginning, the report is usually out after the podcast, but now if you catch the podcast, you can go to api.org at the top right, Chief Economist, and find the report. Excellent. It is already out. So be sure to go check that out. Dr. Foreman, we will get you on here in just a few weeks because we're a week behind. So we look forward to seeing you here in July. Thank you, sir, once again for coming on.
It's great talking with you and seeing you. So take care.
Take care, brother.
Take care.
All right, and that is our monthly visit with Dr. Dean Foreman. Let me see if I can get this halfway decent again. There we go. All right, Dr. Wald, where will you be this week?
This week, well, later today, today being Monday, I'm actually going to be on TD Ameritrade Network on their kind of closing market thing. We're going to talk about long-term kind of forecasts for oil prices.
Okay. Tomorrow, I have on Mark Rossano on Inside the War Room coming in. And I got a question from a listener who said, make the case for me why $73 oil is too high. So I sent that to Mark. He responded, so he knows the question's coming. So Mark will be tackling what he thinks the current price of oil is on Inside the War Room. Should be out tomorrow afternoon or Wednesday. So check it out.
That sounds good.
All right, Dr. Wald.
It
was good to get back. Listeners, good to be back. We will be back next week again, back on our normal schedule, and hope everyone has a wonderful week ahead.
Bye.